Good morning, good afternoon, good evening, wherever you are in the world. Welcome to the channel. Thank you for being here. So, our last projection from the 29th was correct in that we did get a dip here, but I was projecting something more in the 1 to 2% range, whereas the dip that we got was more like 8%. But that's Bitcoin at the end of the day. It's still a fairly volatile asset despite its maturity and mainstream finance acceptance. We did dip into the fair value gap here, shown in orange. But then we dipped further into the CME gap also, which I did not mention last time. And what the CME gap is, in case you didn't know, is the difference in price of Bitcoin futures on the Chicago Mercantile Exchange, CME, between the Friday afternoon close of trading and the Sunday afternoon open. Since Bitcoin trades 24/7 and the CME futures take a break on the weekends, there is typically a gap in price there. And the gap does have a tendency to close eventually. So here we'll see the CME gap in green and the fair value gap here in orange. This, in addition to the market reaction to the Fed press conference, which we'll get into shortly, led us all the way down to approach the 382 retracement line once again. And we bounced off the low of the range that we've been stuck in since July, as well as bouncing off the 200-day moving average, which is pretty bullish, all things considered. So let's talk about the Fed. As expected, they cut rates to the lowest level in 3 years, down 0.25% from between 4 and 4.25 to 3.75 to 4, currently sitting at 3.87 at the time of recording, as well as slowing down quantitative tightening, aka balance sheet contraction, with it to finally end on December 1st. But markets are not happy about it, with the S&P down 0.66% in the 2 hours after the announcement. This was due to the two dissenting Fed committee members, with Jeffrey Schmid and Stephen Miran being the dissenting votes, with Miran pushing for a half-point reduction rather than a quarter, while Schmid preferred the Fed not lower rates at all. Not only that, but Powell also mentioned that the December rate cut is not a foregone conclusion, with markets now estimating a 63% likelihood of a rate cut in December, as implied by the 30-day Fed funds futures prices. Now, much of the discussion at the press conference was about labor market conditions, with Powell basically saying they weren't going to acknowledge job losses that don't yet show up in official numbers, despite the layoff headlines, as we've seen from Amazon, who's planning to cut as many as 30,000 corporate jobs, with, I believe, 14,000 of them already having been cut, as well as UPS to cut 48,000 jobs in management and operations. And as for the other Fed committee members who don't yet believe the labor market weakness is meaningful enough to act on, I guess they're also ignoring the consumer confidence numbers, having slipped to a 6-month low, with worries over job availability rising. Not to mention that the conference board is now projecting that holiday spending will be down 4% on gifts and 12% less on non-gift items. So basically the Fed is stuck. They don't want to acknowledge job losses that don't show up in the official numbers yet, despite layoffs. Inflation is now at 3%. Banks are running out of cash, and they don't have a tool that fixes both of these problems. If they cut rates aggressively, then inflation pumps. If they raise rates, the banks collapse. If they do nothing, both happen anyway, just slowly. And if you recall, the banks are in trouble because they bought bonds at 1 to 2% yields, as mandated by the government, and now they're stuck sitting on them with rates up at 4 to 5%, while depositors flee to money markets. This is the exact setup that killed Silicon Valley Bank, as you'll recall. The proof? Powell's mention of standing repo facility usage rising, aka banks are hitting up the Fed's emergency lending window at an increasing rate. The last time this happened was in 2021 after it launched, and you all remember what was going on around that time. But let's not forget, the federal government is also trapped. They haven't talked about this in a while, but the federal government has $11 trillion of debt to refinance over the next 12 months as of April of this year. And with interest expense already outpacing defense spending and debt rolling over from 1 to 5%, the Treasury needs the Fed to cut. So what does this mean for Bitcoin? It's important to understand that when liquidity is tight, Bitcoin consolidates or dumps. When the Fed panics and adds liquidity or drops rates, Bitcoin pumps. So, what to do? We watch the spread between the secured overnight funding rate, SOFR, and interest rate on reserve balances. That is the orange and the purple lines, respectively. If it goes beyond 0.1%, historically we have a potential liquidity crisis on our hands. Recently, it's just spiked to 0.16%. And you can be sure that insiders are already lining up their bets. And in more bullish news from the CEO of Coinbase,
we also saw the United States of America now has a strategic Bitcoin reserve. So if the United States government is going to begin holding Bitcoin, I think that's going to be a massive driver of demand. And the rest of the G20 countries will probably follow suit. And then the last thing I'd say is that we saw recently the launch of the Bitcoin ETFs by a number of different firms, and Coinbase is actually powering 80% of the custody for those that are out there. But we're seeing a ton of institutional money continue to flow into Bitcoin now that these ETFs are live. So there's a lot of positive tailwinds for Bitcoin, and I think that there's never going to be more than 21 million Bitcoin ever made in the world, and lots of pools of capital still haven't gotten access to it. So that tells me this thing has a long way to run.
And let's take a look at our liquidation heat map. If you recall, the Bitcoin liquidation heat map shows the concentration of stop loss orders of the various leveraged traders positioned on the market. And you can see the concentration is dominantly above the price, with one little spike down here at 106K, which does make sense given the big swing low here. But altogether, looking bullish. Now let's go back to the chart. I want to take a minute to show you something that I've been working on today. Here we have the weekly chart going back to 2023. And I've added the so-called bull market support bands here in green and red and orange. And all that really is a 20-week simple moving average paired with a 21-week exponential moving average. And this has been historically a great support as implied by its name. And you can see here that over the last couple of years since the beginning of this bull market, every time we dip down below the bull market support band and consolidate for a little while, that's been followed up with a huge increase in price. So, in addition to all this, and our range here still seeming to be in play, you can see we've bounced off the low of the range, also bouncing off the 200-day moving average. And momentum here, you can see our RSI momentum is on the upswing. All this in addition to the Fed rate cuts and an end to quantitative tightening, and in all likelihood, quantitative easing in the very near future. I still feel confident in this projection. I think we'll be back toward the upper end of this range in not too long. Might take a couple of weeks, but I'm not too worried about it. Now, before you rush out to buy, or if you think you've missed the boat, we have to talk about DCAing, dollar cost averaging, which is the process of buying at regular intervals in similar amounts over a long period of time. Investing this way reduces the risk of mistiming the market. By spreading out investments over time, you avoid the challenge of buying the exact low of a dip, something even the professionals have a hard time doing. Remember, time in the market is better than timing the market. And that goes double for an asset like Bitcoin that has a cumulative annual growth rate at the time of recording of 77.5% over its lifetime. This means that if you start investing today with as little as $1,000 and commit to a $100 monthly investment for the next 10 years, you'll have nearly $1 million. So whether you're just getting started in your career or you have your sights set on retirement, it is not too late, despite what you might hear, to get into Bitcoin, especially now. Since many folks may not feel comfortable with the technical aspects of Bitcoin and don't want to deal with everything associated with taking custody of your coins, you now have the option to buy the BlackRock ETF, which holds Bitcoin on behalf of investors, meaning you can now participate in the gains from the comfort of your 401k or other stock account. So always remember, DCA is the way. So if you made it this far, thanks so much for watching. Please like and subscribe for more content like this and for the forthcoming Bitcoin Retirement Plan PDF soon to be available on this channel. For those interested, I will be putting together a detailed plan for how you can retire on your Bitcoin savings, and that'll include details on the one thing you can do in addition to dollar cost averaging that'll multiply your gains handsomely over the long run. So thanks for your time and have a great rest of your day.